And joining me on tonight's special show is Tim Kelley from the Montgomery Fund and also Michael Gable from Fairmont Equities. Well, what a week it's been. The shock of the Swiss National Bank and the rise that we've seen in the Swiss franc, and a lot of speculation around quantitative easing. And then, of course, today we saw the GDP numbers coming out of China, the slowest growth rate that we've seen since 1990. So what does this all mean for your portfolio and how you should be structuring at the moment? Let's ask our two panellists tonight. I mean, it's been a massive week in terms of shocks to the market. Tim, just having a look at what's happened, the increased volatility and I guess the shock announcement from the Swiss National Bank and the expectations around quantitative easing out of the ECB, European Central Bank. How are you positioning, how would you say that viewers should be looking at their portfolios at the moment?
Well, I think, Julia, it depends a lot on the investment style that you're pursuing. For us, none of these developments really matter very much at all. There's been a lot that's happened, and it's interesting. But our style of investing is bottom-up value investing. We don't try to base our positioning on a forecast of macroeconomic factors. We're not trying to guess where interest rates are going or what GDP rates are going to do. All we're trying to do is find very good quality companies that are trading at a sensible price. In the long run, we're pretty confident that that will work well, and in the short run, it means that we don't need to pay a lot of attention to some of the news events that come and go.
And Tim, is it becoming harder to find those fairly valued or maybe even underpriced investments in the market?
It is. So the Australian market has had a pretty good run over recent years. The last 12 months, it hasn't done very much, but over a 3-year stretch, it's gone from being pretty good value to no longer being especially good value, and that has certainly made it harder to find the sorts of companies that we're interested in. We've seen some pretty significant moves in the market, but really in the resources space, and we're reluctant investors in resources at the best of times, so we haven't been tempted to do very much at all in that part of the market. The sorts of companies that we like, the really good quality businesses, things like healthcare and new economy businesses that have we think sustainable competitive advantages, they're still trading at pretty high multiples. So it's for our style of investing, it's looking like it's a little bit of a boring market. We're quite hoping that the half-year results will stir things up a bit and generate a bit more opportunity and movement.
But the truth is, everyone's doing the same thing. So those great stocks that were looking, relatively fairly well priced with relatively high yields are all now looking expensive, and basically, have been moving along the lines of bond yields globally. So in this, it is a bit of a different investing environment.
It is. It's frustrating, but one of the adages of value investing is that you shouldn't mistake inactivity for bad investing. There are times when it's appropriate to be patient. You shouldn't feel as though you need to be buying and selling all the time in order to be doing a good job. Sometimes the right thing to do is simply to wait for that opportunity to come along.
Does that mean you're sitting on your previous buys, which would have done very well, but perhaps finding it difficult to find new opportunities out there?
A bit of that, yeah. So the things that we own in the portfolio have held up quite well in recent times, and that's great. The things that have gone down are not things that we particularly want to buy. What we would love to see is a bit of volatility and a bit of new information, because it is frustrating and boring not to be able to identify those new opportunities. So again, I think reporting season, we're quietly hoping that there'll be either some very good news or some bad news that people overreact to, so that we do have a chance to roll our sleeves up and do something. But if we can't justify doing anything, then we'll wait.
What's your question tonight?
Yes, my question's about Infomedia, IFM. I've noticed they lost a contract to Jaguar and Land Rover. Just reading what I've read, looks like their profits will be down, will be up by 5% this year, but probably down on last year's a bit. I was just wondering what the the panel thought of, after losing that contract, what they thought of the company.
Sure. So having a look at Infomedia, IFM is the stock code here. They look at information solutions to different companies, especially in the aftermarket car care sector. And recently on the 6th of January said that they had lost a contract to Jaguar and Land Rover. Now, the last financial results, their profit was up 17%, but of course this would have an impact in terms of their net profit, about 0.8 million, they said. So we have seen a pretty steep pullback for Infomedia. Tim, looking at this, what are your thoughts on this company?
Yeah, well, having said it's a boring market and we're sitting on our hands, this is one case where we did take a bit of action recently. In the Montgomery fund, we've owned Infomedia for a long time, and it's been a really good investment. As Julie has pointed out, they did very recently announce the loss of that Jaguar contract. And one of the real attractions of Infomedia for us is that, is our perception that it doesn't lose contracts. It's a business where customer retention rates historically have been very, very high. Once people use the software, they're very reluctant to switch. And so Jaguar was a bit of a surprise, and we spent a bit of time understanding what had caused that, to understand whether it was indicative of a broader problem in the business. And we concluded that Jaguar was very much a unique circumstance. There was, at the core of it, was a disagreement about ownership of intellectual property. Infomedia wanted to retain control of their IP. Jaguar wanted to have greater access to it. And that's not an issue that seems to have arisen with respect to other customers of Infomedia's business. So it appears to us that Infomedia has probably made the right decision in surrendering that contract. We don't think it's indicative that they're likely to lose a lot of others, and we do think, or we do understand, that there are a lot of dealer groups currently running pilot programs for Infomedia's software, and the conversion rates of those pilot programs we expect will be quite good. On our analysis, that should lead to, or that gives you a valuation that's significantly in excess of the current share price. So when the shares pulled back very sharply on that Jaguar announcement, we concluded that was an overreaction, and we bought more of the stock.
Sales being at record levels, Tim, here in Australia, but of course, the Aussie dollar's been falling. Is that sustainable? Have car sales reached a peak, and would you prefer a stock like Flexigroup?
Well, the answer to that is, in short terms, we own Flexigroup. Automotive holdings, I haven't looked at in any kind of detail recently, so I won't comment on that one. But Flexigroup, we think, is another business where the market is perhaps being a little pessimistic. Flexigroup, as you've said, it provides financing both retail and commercial across a range of market segments. And historically, it's been a high growth business that has done very well. In more recent years, that growth has slowed somewhat, and there's been a change of CEO, and I think that our assessment is that the market has pushed the share price below its intrinsic value. Our sense is that the new CEO, while he doesn't have the same market-friendly style as his predecessor, we've spent a lot of time talking with him, and our sense is that he knows what he's doing, and part of what he's doing is investing in the future of the business. So there is perhaps a little bit of a drag on earnings in the current period or two, but we think that fundamentally the core of that business is very sound, and that there is an interesting growth path ahead of it. The current price, we think it's not bad value.
Okay, I'm not sure if that helps you there, Tony, but it does look like Tim preferring Flexigroup.
Yeah. Does he think it sort of might hold the 83 level, or maybe risk down to $80, which would be really nice?
Sure. So looking at a few stocks, CSL and M2, and I mean, Tim, it's a really good question coming through from donors, because these have been high growth stocks in the past. I mean, just having a look at M2 Group, in the last 10 years, the stock's up 2,011%. CSL, not quite that level, but it's still a very impressive 700%. The question is whether these rates can continue. I mean, looking at M2 just in the past year, still up 30%, and CSL up by 20%.
Yeah, look, really good question. I mean, firstly, disclosure, we own both of them, and we're obviously very happy with both of them. Adonis. As to future growth, let's start with MTU. So MTU has delivered a lot of the growth it's achieved through acquisition, and in the telecommunication space, there's often a lot of value that can be extracted from good acquisitions. You can take your acquired customer base, put it through your systems and infrastructure, and extract cost savings. And MTU has done really, really well out of acquiring and consolidating in the telecommunication space. It's now gotten to a point where it's not going to be as easy, or there just aren't as many opportunities ahead of it to continue to do that. But at the same time, it is a sector where we think there is some organic growth still to come. And we think MTU is pretty well positioned. It has a very strong low-cost proposition, particularly through its Dodo brand. And at the most recent results, it demonstrated some very healthy organic growth figures. So its broadband offering, it's now selling energy, and there are potentially other things that can be sold through the Dodo brand. It's well received in the market. And we think that while the share price has risen a lot, the value has risen commensurately, and we're still happy to own it at the current levels. CSL, slightly different story. I mean, it's just one of the great Australian businesses. CSL, it's not particularly cheap, but it never is particularly cheap. It's another one where if the price was to pull back materially without any fundamental change to the business, we'd probably want to own more of it. At the current levels, we're very happy to continue to be owners of it, because it's a theme that we like. Healthcare in the context of an ageing population, we think is one of the more attractive themes out there.
So Tim, just with CSL, and just because it is topical at the moment, we have seen a massive rise in the Swiss franc, and CSL of course has one of its manufacturing plants over in Switzerland, whereas most of its sales is in US dollars. Is that going to impact at all on your view on CSL?
It has a small impact, and we understand some weakness as a result of that, but our reason for owning it is a lot more to do with the long-term potential of the business, in the context of that ageing population and the quality of the business. You can sort of see, or our view is you look through things like that and invest based on what you can see the business looking like in 5 years' time.
Okay, so that's from Tom. Tom writes, GBST, the provider of back-office stockbroking wrap and Master Trust software, said at their AGM that they have made a strong start to FY 2015. Do you think that they're good value? Tim, we've got 2 minutes left. What do you think?
Okay, look, it's one that on our sort of screening process, it came up as looking like potentially good value. Unfortunately, we couldn't see enough liquidity in the stock to be comfortable that we could own a material position in it. And because of that, we chose not to spend a lot of time researching it. But it looks to me as though a business which has gone through a period of ordinary performance has now recovered very well, and I think there's a good case to say that it's well worth having a look.
Tim, often I look at banks as sort of investing in the Australian economy. You've got, the banks lending to home owners, businesses out there, companies. And when you look at the Australian economy, it's not looking so good. The retail market's sort of asleep. And then, of course, you have miners, oil and gas. What do you think?
There's certainly parts of the Australian economy which are looking a little gloomy. The housing side of the economy, on the other hand,
still looking great.
Is looking in rude health. I'm not sure that we get a clear steer from that. I mean, all I can suggest is that from a valuation perspective, CBA, I mean, it's the most expensive of the big four. It's been a really good, well-managed bank, so maybe it justifies a certain level of valuation premium. Our judgment, when we've looked at it, has been yes, it maybe warrants a valuation premium, but we don't think it warrants that much. So we prefer ANZ and Westpac, having regard to that balance of quality and value.
Okay, so from a valuation perspective, Tim preferring ANZ and Westpac, Michael liking CBA and thinking that it's likely to bounce higher off these levels. So I hope that helps you out. Let's go to our next caller. We have James on the line from Port Melbourne. James, welcome to the show. What's your question?
Hi guys. I just wonder if you can help me out. I own in my super fund some shares such as Argo, AFIC and Milton, and I'd like to get some exposure to the American market. Are there any companies over there who operate specifically like an Argo or an AFIC? That is, they buy the top 10, 15, 20 companies and provide either a dividend or growth?
Sure. So having a look at listed investment companies, but for the US market, we know there are a number of exchange-traded funds out there that target mainly overseas indices, but any suggestions here, Tim?
Look, I think what you've suggested is probably worth exploring. I mean, there are a couple of ways that you can invest in a given international market. One is to buy an ETF, which simply aims to track the index at low cost. And it sounds like your view of some of the LICs you're in is that they do that, and I'm not sure that's right. I think they might be a bit more trying to actively pick the better stocks rather than just trying to replicate the index. So it may be that an ETF is actually what you're looking for. If what you're looking for is a more active LIC, someone that will choose the stocks in return for a management fee, I'm afraid I don't have any particular suggestions there. It's not a market I'm sufficiently familiar with to offer much, I'm afraid.
Michael, and while Magellan Financial Group and the flagship fund have come up, what do you think, Tim?
Well, I need to disclose that Magellan own a part of Montgomery, so we're very close to the Magellan guys. And look, Magellan flagship fund is probably not a bad example of what you might look at if you're wanting to get that active exposure rather than just an ETF style passive exposure. And there are other Magellan trusts that you might look to invest in. As well as the listed vehicle, if you want to get exposure to an actual stock picker who will try and put you into the best companies.
James, hope that helps you out. A number of ways that you can access the US stock market through the ASX here domestically. Let's go to our next caller. We've got Harry on the line from WA. Harry, welcome to the show. What's your question tonight?
Well, firstly, thank you, Julia. And my question is on KAR, the former market darling, Karoon Gas.
Sure.
Karoon Gas has been pretty chopped up along with all the other oil stocks in the sector. You may recall they spun off the Poseidon assets for $600 million, and they're really kicking some pretty strong goals off that Santos Basin area offshore Brazil. And I was just wondering, I know your panellists you got there now probably won't agree it's a value play, but I'm thinking Buffett-wise here about when people are fearful of being greedy, given the fact that we won't see oil down at these prices forever. So I'm just wondering a technical and maybe a fundamental view on Karoon Gas.
Sure. So having a look at Karoon Gas, we know that the oil and gas space has been a very difficult space over the last couple of months. Karoon Gas, of course, over the last 3 months, down 33%. Over the last year, down by 45%. Notice that Wilson HTM has one of their picks, and they've just downgraded their oil forecasts to $59 for this year and $70, that's US, for next year, and that's Brent oil. And their 3 top picks in that oil and gas space are Karoon Gas, Beach Petroleum and Drill Search. So any thoughts around that one, Tim?
Look, I probably don't have much that's very useful to add on Karoon. It's not a space that we've been active in. To give you a bit of background, I mean, we invest where we can be comfortable that the value of the company that we're buying is greater than its share price. The problem with Karoon and with any sort of resources business is that in order to know what it's worth, you've got to know what the commodity price is going to do. And in the case of the oil price, I don't think anyone knew it was going to do what it did. Certainly we had no ability to foresee that. And that inability to accurately value this sort of business means that for us it's very hard to ever make a convincing valuation case. When that happens, we're saying we don't know, and the right strategy we think in those circumstances is not to invest. We'll move on and find something else that we can value and where we can get comfortable that we're getting more than we're paying.
Okay, Tim, would that change your view on Challenger?
No, look, our view on Challenger is that the long-term story is actually a really good one. So Challenger, the core of its business is retirement income products. So you give them a bunch of money and they pay you an annual income either for a period of time or until you die. And stepping back from it, we think firstly the pool of superannuation assets in Australia is clearly growing. The proportion of that pool which is in a sort of drawdown as opposed to an accumulation phase is growing. And we think that the penetration of annuity style products in the Australian market is quite low relative to global benchmarks and relative to what we understand the government would like to see. And coming out of the financial system inquiry, we saw a clear indication that there was a perception that more needed to be done to increase the adoption of these sorts of products. So we think that in the long run there's a lot of tailwind that supports a view that this business will be worth substantially more in 5-10 years' time. The recent regulatory change we think was a blip. We think longer term there is plenty of scope for growth in the business, and Challenger is really a market leader in that space. So a business that stands to do very well out of those long-term trends.
Give him a credit. Tim, what do you think of Beta?
Yeah, look, we loved it at the IPO. It was floated at a very good price, and we, like a lot of people, tried to get as much of it as we could. We've since sold it. We think it continues to be a good business. But when one of our analysts went through the financial statements in great detail, we emerged with a view that we thought that the growth in years to come might be somewhat less than the market was expecting, and that was enough to make us think we didn't want to own it for very much longer. But having said that, it continues to be a good business with interesting prospects.
And prospects. So we might start off with you, Tim. What do you think of this one?
Yeah, look, it's not a stock I've ever looked at, and I'm not sure why it hasn't appeared on our screens. It's almost 300 million of market capitalisation, so it, unless there's a limited sort of free float, it should have enough liquidity. And based on what brokers are projecting, and brokers are projecting really healthy growth in earnings. From 9.1 million for 2014 to 17.3 in 2015, 27.3 and then 41 in 2017. If you believe those forecasts, then the business looks cheap, but I suspect that the market is reluctant to believe those forecasts, and without having looked closely at the business, I can't really comment on why that would be. One of the issues is that broker forecasts often turn out not to be delivered. So I think there's maybe a question around who are the brokers that are publishing these forecasts and whether they are to be believed. On the face of it, the numbers look okay. But I don't know much
Tim,
more
you
about
sort of mix Asia and casinos, and you think it should be a winning mix. But then you look at stocks like Crown, and it hasn't been doing so well over the last year.
Well, Asia and casinos hasn't been a great story recently. I mean, China has had a massive crackdown on corruption, and it turns out that a lot of the casinos in Macau were dependent on corruption to earn a living. So that may be part of the issue. If it is, in fact, it must be part of the issue, and it may be that the broker forecasts that I can see on the screen are badly out of date and just haven't been updated because it's a liquid stock.
Sure. So Doneco, luckily not having its flagship casino in Macau, but in Vietnam, but certainly the stock price not looking so crash hot. What do you think, Michael?
Yeah, I'm not familiar with it either. I'm just trying to find out what's going on here. I've seen
one thing. Sorry to cut across you, Michael. Its casino is located on the border with the Yunnan province, China. So the corruption crackdown, I think, will affect them as much as anyone. Sorry.
No, that's...
There. Tim, what do you think of this one?
Yeah, look, so we own ResMed in the Montgomery Fund, and we're believers in the growth of the sleep apnea market. It's a market which we think it's tremendously underdiagnosed, and there's tremendous benefit to society from diagnosing and treating it. So we think there is a reasonable baseline of growth there. SomnoMed is very different to ResMed. So ResMed is a world leader in sort of masks that basically keep your airways open at night through continuous positive pressure. SomnoMed produce an oral device that changes the shape of your palate and your mouth to allow you to breathe more easily. It's a tiny business compared with ResMed. It hasn't yet been able to generate much earnings, but brokers have expect big things for it. Is about as much as I can say.
Okay, so have a look at Slater and Gordon. They're another one that's been doing quite well. Tim, what do you think of this one?
Look, I think, if I'm not mistaken, this is another one that is sort of pursuing a growth by roll-up in an industry where I don't think there's much by way of consolidation synergies, and that's a sort of style, if I've understood it correctly. That's a style of investment that we think you need to be very cautious about. On the face of it, the valuation looks to be close to fair value, so that is fine. And I'm afraid I haven't looked at it in enough detail to say much beyond that, other than valuation looks fine, but be wary of growth by roll-up in industries where there aren't obvious acquisition synergies, because all too often those strategies work for a while and then they stop working, and it's not the place you want to be when they stop working.
Okay, we do have Anthony on the line from Adelaide. Anthony, welcome to the show. What's your question tonight?
Thank you, Julia. Thanks for taking my call. I called a while ago and spoke about Credit Corp to David Hunt, and he thought it looked like it was going much higher, around $13 to $15. Sure. Now, I'm quite bullish about it because I've already had some, and I just bought some more. But I would really like to hear what Tim has to say about it in relation to its fundamentals.
Sure. So having a look at Credit Corp, stock been doing extremely well, hitting $10.75 today. Recently, we also saw back in December revised guidance from the company, and of course we saw an upgrade coming through there, which is always nice to see. Tim, what do you think here?
Yeah, look, Anthony, this is another one that we have owned in the Montgomery fund. We sold it some time ago, and it's I think now apparent that we sold it a little bit too soon. We had some concerns that they might find growth more difficult going forward, given maturity in the Australian market, and not necessarily an easy market to grow into in the US. Having said that, it looks as though we may have been a bit pessimistic on this one. It's a business that has delivered consistently in excess of 20% return on equity, and it has been able to deploy incremental capital whilst earning that good return on equity. And if it continues to deliver those sorts of numbers, then you can ascribe a value north of $12 to it. Currently trading at $10.75, so it's potentially an interesting opportunity in the medium term. I mean, the simple numbers are quite striking with Macmillan Shakespeare. It's their share price peaked at $16 a couple of years ago. For FY15, it's projected to make $71.1 million, which is higher than it's ever made before. But the share price is at $10.40, a long way below the previous peak, which tells you that the market is worried.
Not willing. Do you think there's ever going to be a change to fringe benefits?
And that's the thing that that it's weighing on the market's mind, and you do need to think about what is the likelihood of that change, which would have a very material effect to the value of Macmillan Shakespeare if it did come to pass. But we think if you do a weighted average or a probability weighted valuation on Macmillan Shakespeare, it's hard to come up with a number that's lower than the current share price.
Okay, so Tim's saying it's worth the risks. MMS was the stock code there. Let's go to our next caller. We have Anthony on the line from Sydney. Anthony, welcome. What's your question tonight?
Oh, hi. My question for the panel is Oz4X. I just noticed that it's fallen a lot lately and got a good return on equity and zero debt, and I was just wondering what the panel thinks going forward.
Oh, so we might go straight to Tim on this one. Oz4X, they are looking at cutting the relationship with Westpac. I guess the two...
Yeah, well, Westpac, I guess, backing out of the business that they had with Oz4X, which the market has reacted to. I'm not sure that that's a particularly big problem for Oz4X, but Oz4X is one that we have looked at. It's got some good metrics and an interesting growth profile. We decided that it wasn't something that we wanted to own, and I think if I boil it all down, Oz4X is a business that we determined was in the right place at the right time. So the banks have been gouging mercilessly for foreign exchange for a long time. Oz4X has come along, and with the benefit of an online platform and a low-cost business model, has been able to offer much better rates than the banks, and that's been great for its growth. But it's a space that's becoming increasingly competitive very quickly, and we think that Oz4X is potentially vulnerable to the same dynamic that it's exploited, and that others can enter the space and have been entering the space at a pretty rapid rate, and we think that it quickly becomes a very competitive space, and the profits that were available, we think, start to get harder and harder to earn going forward. So we concluded that it possibly was not worth as much as it was trading for.
We've just seen the CFO, Chief Financial Officer, resigning. It's usually not a good sign for a business. He wasn't there for too long. Tim,
no,
do you see it as a warning
not a good sign.
sign?
It's not one that we've looked at closely. I mean, I think Alison Watkins is a very capable CEO, but that only counts for so much in a business of any size. All I think I can say on Coca-Cola is that it looks like a business that doesn't have a great growth path ahead of it, and while it's a sound business and it throws off a lot of cash, it's hard to see it as particularly cheap even after the price declines that we've seen. So I'm probably a little bit neutral about that one.
What about Telstra?
Telstra, what do you say about Telstra? I mean, it's a business that hasn't grown very much at all over the last 10 years. In the last little while, some operational improvements have come through, and they have been able to extract some growth. But it's a business whose revenue, I think, is probably unlikely to grow at a very rapid rate, and is trading on a multiple that, on any, I think, conventional valuation, you would say looks a bit stretched. Having said that, it pays
the dividend.
And if interest rates go down as they seem more likely to do in the short to medium term, I think we're going to see more of that frustration that people have felt, where they can't get a satisfactory return on cash, on term deposits. They turn to well-known names that pay a fully franked dividend as an alternative, and Telstra will be a beneficiary of that. So I think expensive, but potentially getting more expensive in the foreseeable future. Long term, it's very hard to see how you get a decent return on your investment from these levels, but that doesn't mean it can't continue to rise through 2015.
In terms of the retail side of the business, massive consolidation with these pharmacies. What do you think of its business, Tim?
Yeah, look, it's not one that we've ever looked at. The reason being that for the last 10 years or so, it hasn't been able to generate a return in excess of its cost of equity, and that sort of straight away puts it into a category that doesn't really appeal to us. So I'll probably leave my comments there. I mean, on the numbers, it looks like it's possibly a little bit expensive, and unless it's it looks expensive and it doesn't look like a good business is perhaps all I can say.
Okay, so Tim not really liking it. Michael, watching that 80 cent support, I think Priceline is really the jewel in the crown here, so you'll be wanting to watch sales here, and if we do see that Priceline network continue to see that strong growth, that should be good news for API's share price. But of course, just watching that support level at 80 cents. Otherwise, that head and shoulders pattern that Michael mentioned could come into play, and unfortunately, technically, that wouldn't look so crash hot. Let's go to a viewer email now from John, and John writes, the chairman of MACA, MLD is a stock code, mentioned at their AGM that this share price was trading at around their net asset backing, $1.18. They are now below this, even though they forecast a 10% increase in revenue this financial year. While mining services is a risky area at the moment, they have a faultless record of delivering on their forecasts. So do you think they are worth considering at this price? So obviously a market signalling that they're quite worried about this particular company if it's trading between its net asset backing. It is a difficult space when the tide goes out.
Yeah. I think firstly, I'm not sure net asset backing is the right way to value a mining services contractor, because if the business dries up, then those assets can't be sold for the value that they might be held in the books at. Having said that, I mean the whole space is one that's been really hit very hard by investors in the last little while. And it looks as though Macca is trading on 3.5 times forecast 15 earnings, and if that is a real earnings number, and it sounds like their guidance suggests that it may well be, that does look really pretty cheap. The issue is, what happens beyond that? Does the business sort of fall in a heap after that? And so far, it seems to have grown consistently over a number of years, and it appears to be growing 2014 into 2015. I understand that Macca has a number of sort of gold miners as clients, and with the gold price rising, there may be some reasons to think that their clients will remain in business. So you have to say it's risky. There's a chance that it could go badly wrong, but at 3.5 times earnings, there's also plenty of upside. So it's probably one worth having a good look at.
Okay, Tim.
Look, I think absolutely it's a very risky area, and it doesn't really suit our style of investing, where we don't like to take a lot of risk. But I think for investors, provided they think sensibly about position sizes, there's absolutely nothing wrong with taking risk if the upside is there, and you can afford to lose what's at stake if it goes bad. There's absolutely, I think, nothing wrong with making a judgment that the upside justifies the risk. One that we do like, which is a little bit to the side of mining services, is RCR, and one of the reasons we like that one is that it's probably a majority of its business now is exposed to infrastructure rather than mining, and we think that the prospects are a bit brighter in that space. We also, I think, have we definitely have some regard for Paul Dalgleish, the CEO. We think that he's a very capable manager who we think is able to avoid the bad contracts that so often blow up these sorts of businesses. So that's one that we think has a bit more promise than many of the others.
Okay, and Tim, any thoughts on?
Yeah, haven't looked at Reckon for some time, so I'm quite out of date with it. So some years ago they sort of lost their relationship with Intuit, or the software from Intuit that they had been selling Intuit. I think we're going to start selling themselves. Reckon needed to develop their own products and invest quite a bit to do that. And I'm not sure how successful they've been. They've obviously got it's a space with a reasonable amount of competition in it, and I'm just not up to date as to how well Reckon have gone at developing new products.
Okay. What about Kathmandu?
Yeah, Kathmandu's an interesting one. So Kathmandu issued a profit sort of downgrade, effectively, I think 21st or 22nd of December, saying that sales and margins were below what they'd been in the previous corresponding period. And what was a bit scary in that announcement was some commentary that we expect that this will continue to be bad for some time. And we're revisiting our pricing and strategies. We sat down with some of the guys from UBS today and talked through what's happening in the retail space. And one of the interesting views that came out of that was that the first sort of 3 weeks of December were pretty poor, and then since then it's actually been significantly better. So on the day that Kathmandu released that downgrade, UBS's view is that that's when things started to pick up. So hard to tell. In the past, Kathmandu have issued a downgrade and then come back later and said, well, actually things have improved and it's not as bad as we thought. Possible that could happen again, but it might be safer to wait until we hear a bit more from the company. I think long term, I think it's probably a good business. It owns its own brand. It has international appeal, and I think there's a growth story there. it might be prudent to just wait and see what's really happening with consumer sentiment and the retail market more generally.
Are you looking at any retail stocks, Tim?
Not actively at the moment, but it's a space that I think in the reporting season ahead we'll be certainly having a good look at.
So it looks like we'll be watching those retail stocks very closely. We've been talking about Kathmandu and Reckon, RKN, of course, in that software space, which used to be pretty much a duopoly, MYOB and Reckon, but of course with technological advancements, it is getting a lot more competitive. It's been a monster show. Our last 2-hour Tuesday Your Money, Your Call for 2015.